Hey there, welcome back to Stocks Telegraph, your go-to spot for everything stock-related. If you're into staying up to date with the latest stock market trends and breaking down the numbers, you're in the right place. In today's video, we're diving deep into the financials of DocuSign, Incorporated, ticker symbol DOCU, the company that's revolutionized the way we sign contracts and agreements. You've probably used it yourself, whether it's for work or personal stuff. But what's happening with DOCU's stock? Is it a good investment right now, or is the market sending mixed signals? Stick around as we break it all down. Before we jump into the details, if you find this video helpful, make sure to give it a thumbs up and share it with your friends who might be interested in stock market analysis. Also, drop your thoughts or predictions about DocuSign in the comments. We love reading your insights. And hey, if you're new here, don't forget to hit that subscribe button so you never miss an update from Stocks Telegraph. All right, let's get into it. So let's take a closer look at DocuSign's financial performance. Right now, the stock is trading at about $106.99 per share, and analysts are taking a pretty neutral stance on it, with an average rating of 3.00, meaning it's neither a clear buy nor sell. This is important to know because it suggests that investors are on the fence at the moment. Now, over the last year, DocuSign has been on an impressive run, with a 125.91% increase in stock price. And get this, in just the past month alone, the stock's up nearly 42%. That's some serious momentum. It even hit a 52-week high recently, but it's now just a hair under that peak by about 23 cents, sitting at $107.01. So, the stock's been climbing, and the numbers are looking pretty good. But what does all this mean for investors? Let's break it down even further. First up, we've got DocuSign's return on investment, coming in at a solid 48.16%. That's a great sign that the company is effectively using its resources to generate returns, and their gross margin is equally strong at 78.68%, meaning they're keeping a good chunk of their revenue after costs. Profit margin is another key metric, and DocuSign's is sitting at 34.73%. That's pretty impressive, especially for a tech company in the software-as-a-service space. And let's not forget about earnings per share. This year it grew by 18.41%, with analysts expecting another 5.23% growth next year. But the real jaw-dropper here is their trailing 12 months EPS growth, which is an insane 1,855.81%. Yeah, you heard that right, over 1,800%. That's basically unheard of. On the debt front, DocuSign is in a strong position. Its debt-to-equity ratio is only 0.07. To put it simply, the company has very little debt compared to its equity, which is a great sign of financial health. Plus, the stock is trading 44% above its 50-day moving average, which is another indicator of strong recent performance. So things are looking pretty good, right? Let's dive into the most recent quarterly results to see how DocuSign is actually performing. DocuSign just dropped its earnings report for the quarter ending October 30th, 2024, and here's what stood out. Total revenue for the quarter was $754.8 million, which is an 8% year-over-year increase. Now, the core of DocuSign's business is subscription revenue, and that also grew by 8%, hitting $734.7 million. So, solid growth in both total and subscription revenue. But that's not all. Professional services and other revenue grew by 11%, bringing in $20.1 million. Billings were up 9%, totaling $752.3 million, which further shows that demand for DocuSign services is rising. In terms of profitability, DocuSign's GAAP gross margin came in at 79.3%, which is a tiny dip from last year's 79.6%. Non-GAAP gross margin was at 82.5%, down slightly from 83% in the prior year. But overall, they're still maintaining solid margins. When it comes to earnings, GAAP net income per share came in at $0.31, up from $0.18 a year ago. Non-GAAP net income per share saw an even stronger rise, jumping to $0.9 from $0.79 last year. So in short, they're becoming more efficient and profitable. Cash flow-wise, things are still looking good. Net cash from operating activities was $234.3 million, though it's a slight dip from last year's $264.2 million. Free cash flow also dipped a little, but it's still solid at $210.7 million. DocuSign's cash reserves totaled $1.1 billion at the end of the quarter, so they've got a strong cushion. And they've been buying back stock too. They repurchased $172.7 million worth of shares compared to $75 million last year. This is typically a good sign that the company believes its stock is undervalued and is trying to boost shareholder value. Looking ahead, DocuSign expects total revenue for the next quarter to be between $758 million and $762 million, with subscription revenue expected to range from $741 million to $745 million. For the full fiscal year, they're guiding for total revenue between $2.96 billion and $2.97 billion. And it's not just financials. DocuSign is being recognized all over the place. They were named a leader in Gartner's Magic Quadrant for Contract Lifecycle Management for the 5th year in a row. Plus, they've earned a spot in Incorporated Power Partner Awards for their role in helping businesses thrive. To top it off, they've just launched their Intelligent Agreement Management platform, which uses AI to transform how agreements are created and managed. This could be a game changer for businesses everywhere. So what's the takeaway? DocuSign's stock has been on a strong run, and their financials back up that growth. With solid revenue growth, profitability, low debt, and a growing ecosystem of products and services, they're positioning themselves for even more success in the future. What do you think? Will DocuSign continue its upward trajectory, or are we due for a pullback? Drop your thoughts in the comments below. And if you haven't already, don't forget to subscribe and hit that bell so you don't miss any updates from Stocks Telegraph. Thanks for watching, and we'll see you in the next video.